Understanding preemptive rights, a key component for shareholders. Preemptive rights are a significant aspect of corporate finance that primarily empowers shareholders, ensuring they have the opportunity to maintain their ownership stake during future stock issuances by a company. This article delves deep into the mechanics, importance, benefits, and the types of preemptive rights, enriching the understanding of both investors and corporate entities. What are preemptive rights? Preemptive rights, sometimes referred to as subscription rights or anti-dilution provisions, grant existing shareholders the first opportunity to purchase additional shares in any future offerings before these shares are made available to the public. This right is particularly beneficial as it allows shareholders to maintain their proportional ownership in the company, thereby avoiding the dilution of their voting power and control. Key characteristics of preemptive rights. Early investor incentives, primarily available to early investors or majority stakeholders. Preemptive rights serve as a risk-mitigating measure that allows these investors to offset potential losses when new shares are issued. Not required by law. In the U.S., it's important to note that not all companies are mandated to provide preemptive rights, and such provisions typically need to be stated in the company's charter. Subscription warrants. Shareholders with preemptive rights usually receive subscription warrants that entitle them to acquire a specific number of shares proportional to their current stake in the company. Understanding preemptive rights. Essentially, preemptive rights serve as a right of first refusal. Shareholders benefit from this option but are not obligated to purchase additional shares. This is especially relevant for early investors who may have acquired convertible preferred shares when the company was still private and can convert these to common shares once the company goes public. Contrast with international norms. The usage of preemptive rights in the U.S. is distinct from practices in regions such as the European Union and Great Britain, where preemptive rights are often mandated by law for all shareholders regardless of their stake. In the U.S., their availability remains largely at the company's discretion. The need for preemptive rights. The primary function of preemptive rights is to safeguard investors from dilution, where the ownership percentage decreases as new shares enter the market, which could significantly impact their voting power and economic interests. For instance, if an investor holds 10% of a company, they can purchase enough shares in a new offering to maintain that percentage, thereby ensuring continued influence over major company decisions. Types of preemptive rights. Preemptive rights can be categorized into two main types based on the adjustment mechanisms for purchasing additional shares. 1. Weighted average provision. This provision enables shareholders to buy additional shares at a price adjusted according to a weighted average of the original and new share prices. It can be calculated through either a narrow-based or broad-based weighted average, providing flexibility in how adjustments are applied. 2. Ratchet-based provision. Also known as a full ratchet, this provision allows shareholders to convert their preferred shares into new shares at the lowest price offered during a public offering. This mechanism compensates shareholders by increasing the number of shares they own, helping maintain their ownership percentage even when share prices decline. Benefits of preemptive rights. For shareholders. Voting power preservation. By maintaining ownership percentage, shareholders retain their voting rights and influence over company management. Investment incentive. The opportunity to buy shares at potentially discounted rates serves as a strong financial incentive for continued investment. Loss mitigation. In situations where new shares are issued at a lower price, preemptive rights provide a buffer against losses, allowing shareholders to convert their existing shares into a larger stake. For companies. Cost-efficient financing. Companies can raise capital by selling shares to current shareholders without incurring the high costs typically associated with public offerings. Enhanced company value. By providing preemptive rights, firms can incentivize better overall performance, knowing that their efforts will help facilitate higher future stock prices. Example scenario. To illustrate how preemptive rights function, consider a company that conducts an initial public offering, IPO, of 100 shares and an investor purchases 10 shares, representing a 10% stake. Later, the company issues an additional 500 shares in a secondary offering. The investor should be granted the option to buy 50 additional shares, 10% of 500, to maintain their ownership level. If the investor does not exercise this right, their stake would dwindle to only 10 shares out of 600 total shares, reducing their ownership percentage to less than 2%. Common questions about preemptive rights. What are preemptive rights shares? Preemptive rights shares enable shareholders to buy more shares at a predetermined price before they are offered publicly, crucially preventing dilution of their ownership percentage. Why are preemptive rights important? They serve as an incentive for investors, particularly early backers of ventures, allowing them to solidify their control and influence as the business grows. Do common shareholders have preemptive rights? In the U.S., while common shareholders may have preemptive rights, it is not guaranteed. Companies typically outline these rights in their charter and may issue subscription warrants accordingly. Waiver of preemptive rights. Preemptive rights can be waived if all shareholders agree to do so. In the U.S., companies may utilize the SEC's waiver form to remove such rights from existing agreements. Conclusion. Preemptive rights play a pivotal role in the corporate landscape, primarily serving as a safeguard for existing shareholders against the dilution of their ownership in the face of new stock offerings. They benefit both shareholders and companies by promoting sustained investment and efficient capital raising practices. Understanding these rights is crucial for investors and companies alike, as they navigate the complexities of stock ownership and equity financing.